Learning how to read crypto charts is essential if you're interested in crypto trades and following the marketplace. But, much like blockchain, technical analysis and market trends have a very steep learning curve. In the first part of this two-part guide, we'll go over the key concepts you need to begin your journey into technical analysis. The main concept you should understand from this video is Dow theory. It's a long-standing form of technical analysis written by Charles Dow. It was slowly released through the late 1800s in the Wall Street Journal. So what do you need to know about Dow theory? And how do its tenets apply to crypto? There are 6 parts to this theory. 1. Markets have 3 types of movements. The main movement is essentially the long-term outlook. How does the price of an asset look over the course of a year or more? The medium swings are price changes over the course of 10 days to 3 months. Finally, short swings are the smallest trend lines. How is the asset behaving hour to hour? Looking at all these trends is key to understanding how the market feels about an asset. 2. There are 3 major phases to a market. The accumulation phase is where investors that are in the know are purchasing an asset before the market catches on. Then the absorption phase begins, and rapid price changes begin as the larger public starts to participate. Lastly, the distribution phase is when early investors begin to sell off their holdings. 3. The market discounts all news. Any new information is very quickly reflected in the market. The sum of the world's hope, fear, projection, and history are all taken into account. 4. Averages in the markets must confirm each other. Essentially, this means that if solar energy stocks are surging in price, you would also expect solar panel manufacturers to be surging in price. Markets that rely on each other should generally move together. 5. Volume confirms trends. When there's a very small amount of actors in a space and there are price swings, it could be related to anything. It's hard to tell the motivations of one or a few people in a market. On the other hand, if price swings happen on large volumes, then it's more indicative of the state of the asset. When many people act in a certain way, it's a more clear trend. 6. Trends exist until they definitively don't. This one's pretty simple. It's basically saying to look at the big picture. Always give the longer-term trend the benefit of the doubt when there are short-term market swings. It's very tough to know when one trend is ending and a new one is beginning, so err on the side of the long-term pattern. So these are the 6 major points of the Dow theory, and I'm sure you can already see many of the ways that they apply to crypto markets. There are a few more tips we'll cover today that, when combined with Dow theory, can help to give you a clearer picture of an asset. Market cap, as we discussed in a previous guide, is a good starting benchmark. Coins with very low market caps tend to behave in a much less predictable manner, and vice versa. This ties in with the volume confirms trends tenet. If a few people are taking part in a market, it's very hard to get a clear picture. If there's a lot of activity, trends start to emerge. Relative Strength Index measures price movement by comparing the current price to past performance. It boils down to a ratio between the average of days the assets was up and the average of days it was down. Luckily, almost any exchange and trading tool will calculate this for you. RSI ranges from 0 to 100, and RSI over 70 tends to indicate that an asset has been oversold and will likely go down, while the inverse is true for an RSI below 30. By no means is this a foolproof indicator. If it was this easy, everyone would be rich. RSI is just one tool, like the other concepts we've presented here, to help you get a more clear picture of a market. The last concepts we'll cover quickly today are support and resistance. Support is the low end of an asset's value that is often touched multiple times before bouncing up again. Similarly, resistance is the high end of the value that is hit before the price tends to fall back down. They basically represent a point where people see purchasing an asset as a bargain, and a point when people see selling an asset as beneficial. So if traders think my coin is a bargain at $100, they'll leap in to purchase it when it hits that price, and it isn't likely to go much below there. If they think $150 for my coin is overvalued, or even just a nice profit, many will sell at that point and the price won't go much higher. Of course, there are many other potential reasons for this at play in any given market, but this is an introductory way to look at it. In the next guide, we'll look more specifically at different types of charts and more complex tools to help you understand markets. In our last guide, we talked about Dow theory and some broad ways in which markets move. But of course, this isn't the whole story of technical analysis. In this guide, we'll dive into reading more specific types of charts and movements. First up, one of the most prolific types of chart out there, the Japanese candlestick chart. Here's what they look like. Chances are you've seen them before. Each candlestick represents how the price has moved over a given period of time. So, off the top, a green stick means the price has moved up, a red stick means the price has moved down. Perfect. This part here, the body of the candle, shows you the difference between the opening and closing price of that time period. The shadows at the ends show you the highest or lowest point the price has gone over the course of that period. So how can we use these to understand assets? One of the major ways is with trend lines. Trend lines help us to confirm and identify the types of trends we talked about last video. A trend line is an upward or downward straight line that intersects at least two price points. At a base level, this probably sounds silly because you could essentially draw a line anywhere, so let's qualify this a bit further. A strong trend line should, ideally, cross as many different points as it can. As a general rule, a trend line should go through 2 points and have at least a third point to help validate it. The spacing of these points is also important. If the points are really close together, you're looking at such a small window of time that it's impossible to confirm a trend. Conversely, if the points are too far apart, it's hard to say that the points have anything to do with each other. Finally, you should look at the angle of any line you're drawing. A very steep line in either direction is unlikely to be a trend. It's simply not sustainable for an asset to consistently rise or drop 30 to 40% day over day for an extended period of time. Alternatively, a line that's too close to horizontal is basically a support or resistance line that we talked about last video, not a trend. So what do these trend lines allow you to do? At their best, they can help you observe how an asset is moving and where it may go next. Their biggest disadvantage is that it's easy to draw trend lines on almost any chart. So you have to be able to recognize bad trend lines like we described, and be conscious when you draw your own that they are just a tool. No system or analysis is the be-all end-all of where a market will go. Like we said last time, these tools can help you understand why markets move the way they do. They are not foolproof schemes for price predictions. Simple moving averages are another, more mathematical way to try and identify trends. A moving average is calculated by averaging a certain number of past data points. When you plot the moving average, you can see a smoothed out version of the data that is far less disjointed and fluctuating. The math looks like this, where A is the closing price of the asset at the end of a given time period, and N is the period over which it was calculated. So, if over the last 10 days your price looked like this, we can sub it into the math as such, which gives us an SMA of 5.4. So if you wanted to calculate and plot this data, you would continue to calculate 10-day chunks and place them on the chart. As we stated earlier, the result you can see is a highly simplified look at price movements, with much clearer trends. When we relate this to the 3 major movements of Dow theory, people usually use an SMA over 200 days to look for long-term trends, 50 for medium-term, and 20 for short-term. One way we can extend the data given to us by an SMA is with the Bollinger Band. Bollinger Bands essentially take the SMA that you calculated above, but then also plots a positive standard deviation above and negative standard deviation below each point, creating a range for each bit of data. A standard deviation is just a measurement of how much variance can be present in any data calculation. This is very common with statistics and finance. Each point in your SMA will have a band above and below it that indicates how much that average price has moved from its average in that time frame. When the band is very wide from the main data point, that means the asset is in a period of high volatility. It's taking huge up or down price swings that deviate greatly from the past average. As you might expect, when bands tighten around the average points, you're in a period of low volatility. You can typically expect smaller price movements in these periods. Bollinger Bands are a tool that can be used with an SMA to try and identify how much price volatility can be expected at a given time. And that's it for our 2-part guide on reading crypto charts. Remember, none of these tools on their own are any kind of golden ticket. Each one simply gives you a different lens to observe the movement of markets. When used in conjunction with each other, you can start to identify trends and get a better understanding of how assets behave under certain market conditions.